thank you for taking the time to click on today's video. Today, I don't want to insult your math intelligence, but let me ask you a question. Isn't it true that for most of us, when we're withdrawing money for retirement, that we expect to see the balance of our account decline by the amount withdrawn? I mean, it's pretty simple math. If I have $100,000 and I take out 4%, I take out my $4,000, I expect my balance to now be $96,000. That's just basic math. But the reality is that people all over the United States are doing this today, and they're doing it more and more. They're doing it consistently, they're doing it systematically, and at the same time that they're watching these dollars flow out, they're watching these dollars decline, and they're becoming more and more anxious about the fact that they might run out of money in retirement. If we think about the different ways that we can invest our money, we know that we've been conditioned to think that the best place for our money in retirement is in the stock market. And you know what? There is absolutely zero argument for me with regards to having stocks as a legitimate investment for retirement. But the reality is that when we're sitting with most of our money in the stock market and we take that withdrawal that we need so that we can supplement our Social Security, we can supplement our retirement, we can have the money that we need in order to support the lifestyle that we've grown to love and enjoy, the reality is that there is no guarantee that we're simply going to go down by $4,000. There's no guarantee that the $96,000 is going to stay $96,000. There's no guarantee that the $96,000 couldn't go lower to $92,000. And there's certainly no guarantee that the $96,000 is going to come up by $4,000, making us net and whole again. We already know this, but why are we willing to take the risk? Why are we continually, as retirees, taking this advice? What if we could simply change the math just a little bit? Like, we're not going to do anything, that's beyond the scope of actual ability, but we're going to change this math just a little bit. And what we're going to do is we're going to change that $96,000, and we're going to change that $96,000, and we're going to make it back to $100,000. How is that possible? Well, I'll explain how it's possible. You see, when we're investing for retirement, we're wanting to grow. We're wanting to take on risk with our money because we know that we're not retired yet. We know that we have plenty of time before we get to retirement, and we know that those ups and those downs, they don't really affect us. In fact, we know that the ups and the downs actually benefit us because they allow us to do something called dollar cost averaging. As we're putting money time after time, pay period after pay period, into that 401k or that 403b or even our own personal accounts, what we're doing is we're buying more shares, and we're buying more shares at different prices. Sometimes the price is kind of high, sometimes the price is low. And when that happens, we're averaging out the price that we paid overall. But once we get and we transition to retirement, now the game changes for us, right? Because the paycheck has stopped, and we need to do something in order to, consistently replace the income that we've lost. And we need some strategy that's going to be able to help us accomplish that. In other words, your focus has shifted away from growth, and now your focus is on income. Well, what if we could have an account that's like this? What if the math in retirement worked like this, where I had $100,000, I could take out $4,000, and I still ended up with $100,000? And their answer is you can. But you have to invest for income. You have to invest for the I. You see, when you were in the accumulation stage of your life, you were focused on the growth. That was your goal. That's what you were trying to do. You were trying to put points on the board, stay up with the market, even beat the market if at all possible. But once you get to the distribution stage of your life, this number is important that it doesn't go to zero. And this number is even more important because that's the number that you need to live on. And if we don't make the shift from accumulation and growth to income and distribution, well, we're not likely to have a very good retirement. So where is it that the math could work out this way, where I can have 100,000, take 4,000 and still end up with 100,000? It's focusing on fixed income instruments. Things like individually held bonds, things like individually held preferreds, things like business development companies and real estate investment trusts and exchange traded debt notes. You see, the universe of fixed income is very broad. And the irony here for most, I would say most every retiree that I work with, is the fact that if you want more output, if you want more income, you naturally have to reduce your risk. You have to exit the stock market, the common growth stock market, and invest in things that are more focused on the production of this. Now that's true, it's not entirely true, because here's the thing. I personally love equities. I love stocks, but I love the stocks that are going to pay me a 4.5% dividend. Now granted, there's not a universe of these. You have to be very, very diligent. You have to know where to look. This is where working with a fiduciary whose specialty is that of creating income for his or her clients. But the reality is that there is plenty of stocks out there that we can access, that we can own, and that we can get our cake and eat it too. We can have our income. And you see, you really don't need to be worried about selling shares if you have enough income that's being produced for you off from interest and dividends. I'll give you an example. I had a gentleman that was in some time ago, and this gentleman walked in and he said, you know what? I'm a buy and hold investor. I said, okay, fine, wonderful. And I said, so tell me, how are you getting your income? And he said, I'm taking it from my brokerage account. And I said, no, I understand that. I'm asking, how do you get your income? And he became really frustrated, and he's like, I don't understand your question. And I said, okay, let's drill down to the mechanics. How are you getting the income that you need for your retirement? And he said, well, I'm selling shares. And I said, oh, okay, so that means that you're not really a buy and hold investor. And all of a sudden, the light bulb went on. He realized that even though he considered himself the epitome of the buy and hold investor, he was actually doing the opposite. You see, that's the beauty of income. The beauty of income is that when I have interest, when I have dividends, and I have enough of those interest and dividend dollars, I can honestly hold that position that I want to hold because it's paying me enough. I don't have to sell the shares. I can have the time for that share to appreciate, to come to its full value, its full potential. You see, the math is really real. There are things in life that we can have 100,000, we can take 4,000, and we can still end up with 100,000. We just have to know how to do it right. Well, I hope this video has been challenging to you. I encourage you, give us a thumbs up if you like this video. Share it with your friends because they need to know this kind of new math as well. I'd ask if you like these little videos, besides the thumbs up, hit that subscribe button. We'll go ahead and we'll notify you each and every time we have a video. Thank you so much for watching, and remember, it's up to you to make today a great day.